Now, the next slide on how to manage the economy, there's two approaches, the classical approach and the Keynesian approach. The classical approach is basically let the market do its job. You see that it's a laissez-faire model, means little to no government intervention or regulation. It argues that the business cycle goes up and down, and that eventually the forces of supply and demand will work and the market will fix itself. When in the face of a recession, it suggests austerity, the laissez-faire class. Don't have the government intervene, don't have the government regulate, let the market fix itself. There'll be a market correction. Okay? With this, yes, what happens is that there's less tax revenue coming into the government because people are making less money, and with lower revenue coming into the government can't spend. But the classical approach suggests don't deficit spend, don't go into debt, wait till the market corrects itself. On the other hand, the Keynesian approach largely suggests the opposite. When there's a recession, government should step in, engage in job creation programs, deficit spending, go into debt, spend some money now to get people back to work, to get the factories and the businesses producing goods, get people back to work to get a paycheck, and then for them to spend money and to bring more and to spend more money and put dollars into the economy. This was championed by FDR in the Great Deal programs, version of Keynesian approach. The Keynesian approach says the government needs to do something because otherwise waiting for the market to work will harm individuals as they wait for that market correction to occur. In terms of managing the economy, the government takes some steps, mainly in monetary policy, fiscal policy, and some regulation. Monetary policy is set by the Federal Reserve. They're the ones that are in charge of setting the discount rate for banks, which eventually leads to the Federal Reserve having a direct impact on interest rates. So when interest rates are really high, people are encouraged to save money because the more money they put in, the interest grows and they get more money in the end. Oftentimes when you want the economy to slow down a bit to prevent inflation, interest rates will go up to encourage people to save their money. Because if the economy is growing too fast, and what happens is the demand for goods rises really fast, that means the prices for goods rises fast, and by definition that's inflation. What we're more accustomed to seeing, at least in the last 10 years, are low interest rates. When interest rates are very low, it discourages individuals from saving. They don't get a very good return on their investment. In fact, interest rates are right now below the rate of inflation. So if you're saving money in some respects, you're actually losing money. Now this was set up the current situation was set up in 2008 during the financial crisis when the housing bubble collapsed. People lost their jobs, unemployment rates approaching 10% in areas higher in other cities and communities like Las Vegas. What's the Federal Reserve do? They lower interest rates, and the rates went down to near zero. The idea was that we want people spending money, put money back into the economy to try to generate GDP. And so the chairman of the Federal Reserve has a lot of power. During the 2000s, everybody was wondering when Alan Greenspan would die, and they were hoping that he would not because he was a guru of this. Generally speaking, the Federal Reserve's biggest influence is on the interest rates. Getting back to inflation, in terms of what is good, what is bad, and how monetary policy fits in, when inflation is too high, obviously it's too expensive to buy things. There are countries like Zimbabwe, Venezuela, you have to come in with a barrel full of money to buy normal goods. And that's inflation's way too high. Now, we would like a low inflation, but when it's too low, businesses aren't making as much money. But generally speaking, we'd like to have an inflation rate that's not zero, but is kept in check. Obviously, too high hurts the economy. Well, an example of this, of too much inflation, World War I Germany, very much in debt, owed money for the war efforts. So what did it do? It printed more money, as we talked about in the previous lecture part 1, you print more money. That's an influx of supply of dollars, or in the case of Germany, marks on the market. That means what happens is it may seem like, oh, there's a lot more money so people can afford things, but no, what happens is that the price of goods go up and the value of the currency goes down. So essentially what happens, at the bottom of the slide, the businesses in Germany increase their prices. Well, what happens, the government prints more money, which then the producers increase their prices again. Government prints more money, and eventually the currency becomes worthless, and you have to pay for goods with wads of cash, wheelbarrows full of money. The other way the government works with to try to manage the economy is through fiscal policy, taxing and spending. We know that Congress, and especially the House of Representatives, has a responsibility for taxing. The president can try to frame the political climate and try to push his budget forward and suggest tax cuts or tax increases. The other thing that the government can do is they can certainly step in and regulate. And we see this with price setting. On the slide that says regulation, the government would come in and say a good can only cost X amount. We saw the problem with that with rent controls. You often will see, especially with rent controls, a shortage. Most of the time we don't see a heavy regulation of the economic market in the U.S. We don't see much price setting. We see some entry restrictions in terms of tariffs on foreign goods to promote people buying American-made goods. Think of vehicles, import tariffs on Japanese or European cars. And then there's some regulation where the government steps in and provides a lot of oversight over business firms, kind of steps in to make their decision-making process. We don't see that as much in our more market-based economy, but you get to countries like China that are more command and control, and you see more government intervention into businesses. Taxes, well, we know we have to pay them. The reason for them is because if they didn't exist, we wouldn't have programs. And why? Well, that's a collective action problem. So suppose there was no government regulation requiring you to pay taxes, and an IRS agent each year comes to your door and asks, will you donate money to the military or to national defense? You don't have to, but we would really like for you to. The collective action problem is that nobody would really want to. It's a free rider problem. You hope that others will pay taxes and you don't. So what the government has to do to overcome this collective action problem, obviously, is require you to pay taxes. And if you don't pay taxes, you go to jail. Taxes are necessary. They're a necessary evil. The level of taxes, however, is up for debate. Generally, in the U.S., we see a progressive tax system. That's where lower-income individuals pay less money, and the rich tend to pay a higher proportion or percentage of their salary to taxes. We tend to stay in a progressive system, and the level of progressivism just depends upon which party's in power. You see Trump arguing for tax cuts on more wealthy individuals and corporations. He's not necessarily arguing for higher taxes on the poor, but he's arguing for less burden on the top earners, whereas you see Bernie Sanders will argue that we should be even more progressive. So Trump's let's move a little bit away from the progressive system. Bernie Sanders, let's move more towards a progressive system. Let's increase the taxes on the rich even more than they are and lower the burden on the poor. Either individual, their policies would still fit within a progressive tax system. A regressive tax system is where the poor pay more. We don't really see that, but we do have that implicitly in sales taxes and sin taxes. Sales tax, when you buy a product, paper, a Coke, you pay a sales tax on it. That tends to hit the poor harder than the rich. The poor are less able to afford an additional cost on their products compared to the rich. Same with sin taxes, like taxes on cigarettes, alcohol, etc. That's an added cost that, yeah, everybody pays, but it hits the poor harder. Others have argued for a flat tax or proportional system. This would involve everybody paying a flat rate, whether that be 20%. Say if it's 20% the flat tax rate, then Bill Gates pays 20% of his income to the government, and an individual making $10,000 a year are on minimum 20% of that income to government. There are pros and cons to that. One is it's equitable. Everybody pays the same. Is it efficient? It's hard to say. Is it fair? Also, very hard to say. Some will argue that a 20% tax on Bill Gates won't hurt him as much as a 20% tax on somebody that's in poverty. Others will say it's fair because, well, everybody pays the same rate regardless. But in general, we have a progressive tax system in the U.S. We're going to skip the next slide. Basically, what we'll go over to is the Laffer curve. This is kind of the art. This curve kind of tries to suggest what's the optimal tax rate. We don't know. The theory behind the Laffer curve is that, as you see on the x-axis, the tax rate percent, and then on the y-axis, government revenue. What's optimal is somewhere in the middle. Too low of a tax rate means not enough money is coming in for the government to spend and to fund programs. Too much of a tax rate obviously is burdensome to the citizens. So somewhere in between is an optimal rate. Taxes, as you know, are used to help individuals that are indigent or poor or falling below the poverty line. And some people will argue, well, people should be more austere. They should take more responsibility. Well, maybe, maybe not. In terms of saving, the U.S. doesn't save that much. The average citizen only 4.5% compared to Sweden at 12%. So individuals that earn below a certain level may not be able to save. What we do also see in the U.S., along with a sizable number of individuals below the poverty line, is income inequality. Whether or not you buy into Bernie Sanders' claim about the top 10th of a percent or percent making the most, well, the data tends to show it maybe not as drastically as to the extent as drastically as Bernie says. You see on the income inequality in the U.S. graph, the top 1% make $383,000 or more. You see the bottom quarter, roughly, bottom 24% make $25,000 or less. So yeah, there is a bit of a pyramid system in the U.S. Where you've got a few people at the top and a lot of people at the bottom. It's not exactly perfectly a pyramid. I would say it's, you got a few at the top, a lot in the middle, and it kind of narrows in. I don't know if that's an accurate reflection or not of income in the U.S., but it's not a perfect pyramid where you got a few at the top and everybody else is at the bottom. It's some sort of function of a pyramid, but it's not perfectly like that. Even with that, what do we do for individuals at the bottom? Either here or here, depending upon how the U.S. system is organized. Most people argue or will support taxes being spent to support individuals that are indigent or can't afford daily goods. To what extent and what tax rate, that depends, and we'll get to it. And it also depends on how the question is phrased. In the U.S., generally speaking, our social insurance mechanisms, where we pay right now from our paychecks into a system that we hope to get from in the future, is with Social Security and Medicare. Our tax dollars also go to redistribution, which, even though people will say, yeah, we should help the poor, when it's framed in terms of redistribution, like Medicaid, like welfare, tends to be a little less popular. But our tax dollars go to those programs to help individuals that can't afford it. What we see here, and this is important in terms of welfare policy, is it depends upon how it's framed. If you ask the average American, should we help the poor? Okay, or should tax dollars go to programs to help the poor? with some exception, the general pattern will be that a majority of Americans in surveys will say yes. They'll either agree or strongly agree. Survey research suggests that people do want to help the poor. Now, if you rephrase it into a different manner, should we increase welfare spending? Or should tax dollars go to welfare recipients the majority will say no. Welfare has a negative connotation for both accurate and inaccurate reasons, but this is the problem in terms of the U.S. in providing in some income security to individuals of low income. More often than not, people will say, yes, we should help them. We should provide a safety net. But when they're directly asked in terms of, should we increase Medicaid spending? Should we increase welfare spending? Should your tax dollars go to welfare recipients? People will often say no. Even though these questions, the top two and the bottom two, essentially are the same thing, they're framed in a different manner. Welfare certainly helps the poor, Medicaid certainly helps the poor, and it is paid with tax dollars, but people see welfare and Medicaid with a negative connotation. I think what we see from most Americans and from most survey research is that Americans want a safety net for themselves and for others that fall down on their luck. That if an individual becomes sick or loses their job, that there's a safety net to catch them for when they fall, but that safety net is only temporary. That it's just there to catch people and to act as a springboard and a temporary stopgap policy to help them get back on their feet, to get a job, and to earn income. Welfare is not typically seen like that. This idea of a safety net was also part of the reason we saw the change in welfare in the 1990s, the welfare to work, is because people do believe in the safety net, but they don't want people to stay on the system. They want people to get off of it. They don't want people to abuse it. And that's when we saw the change in the 1990s. So the big thing also to remember, and we're going to stop here because the rest you can pretty much probably know from your own experience or can read from the book, is that survey research is important. We use it to make policy decisions. Politicians use it to make policy decisions. But you have to be very, very careful in how you phrase the survey questions, because you can have two survey questions here in the top that look exactly like the survey questions down below, but change a few words and you're going to get drastically different answers. Now, in terms of policy, what does this mean? It means basically we need to find programs that help the poor that don't have negative connotation like welfare. And whether or not we can do that, it's hard to say. I think people tend to be okay with programs like CHIP, Children's Health Insurance Program, and so that if you phrase the question, should we help poor children get health insurance? Yeah. Should we increase spending to the CHIP program? You're probably also going to get a pretty good majority that would say yes. Maybe there will be some divisions along party and ideological lines, but CHIP certainly does not have the negative connotation that welfare does. And so this will be it for income security. Please be sure to work on the midterm this week. If you're in the Monday class, it's due on Friday the 17th. If you're on the Wednesday class, it's due on Sunday the 19th.